Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Monday, January 10th, 2022. I'll do an update on the equity markets, followed by brief updates on a few other the things I've highlighted recently. We'll look at Treasury bonds, crude oil, maybe get to natural gas, and possibly one or two other things that stand out right now. But right now, the easy money, or let me rephrase this, it's as easy as it's been in a while to make money trading the broad markets because volatility is up. In other words, that's where traders make their bang. They get the best bang for their buck when volatility spikes, the daily ranges go up. So you can, of course, you can trade things like the VIX and trade volatility directly. There's the VIX. Wasn't really part of my plan to go over that today, but it's still, down near that support range, and it shows better on the weekly chart here. You have this highlighted recently, $16 support still holding up, positive divergences, everything there. And then your proxies, you can use SVXY or VXX. Those are some of the many VIX tracking ETNs. And I laid out some targets here for you. There's a positive or bullish divergence right there. So if we get the big drop that I think we could see here in the first couple months of the year, then it should be no problem to run up to these levels. I think you can make them out there, and if not, just pause the video and zoom in and do what you need to do there. Just a quick note, and I didn't get to answer every comment from the last update on Friday. I think there was a post with several threads in there. In the comment section, somebody asked if I could do the videos in 1080 high def. I do them in 720 right now, and my video recording software will certainly record in whatever format I tell it. However, the thing is, a lot of these videos like this one are timely, and although I have a pretty good processor and speed, and it'll upload and good internet speed, it's the bottleneck is YouTube. They have to then render the video, process it, and depending on, I guess, how many they're doing at the time, that can be anywhere from 15 minutes, sometimes 10 on a short video, or longer. So if I were to do it in the 1080, it's not really going to give any noticeable benefit. I run my main monitor. I have one, two, three, what is this, 4 monitors, but my main monitor is a 43-inch monitor, and I can max the videos out to full size on that 43, and they're as clear as can be. So I think the 720 is fine. If you have issues, just check your monitor settings, and most importantly, check when I put a video out. A lot of times, if it's timely and actionable information, I'm going to get it out right away before YouTube has fully finished rendering that. What that means is they're going to give an initial version that's rendered in standard definition. And so if you notice that on the site, there's a setting icon, whether you're watching the video directly from right side of the chart or on directly from YouTube. In the bottom right hand corner is a setting icon, little cog. Click on that and then select 720 or auto, and make sure you're playing the video. And if it's not, and 720p is not available, which is high def, it's the lower version, then all you have to do is refresh the page or wait a little while, and usually within a few minutes they'll have that 720p high def version. So, okay, so sorry for that. I just want to get that out there because I really think it's important that you can see the levels on these videos, and any phone should have a pretty good resolution on the screen as well. All right, first up, no, that was the VIX. I just kind of tangentially went off on that because of the volatility being high. But again, this is let's just give you this example today. So QQQ, we came down, we had the sell signal with the break of 377.64 and the uptrend line. That's still very much intact right now. Negative divergences. I'm going to get to SPY here in just a second. And then I threw out for you guys this earlier today, trading out for active traders. Gave you the support zone right here on NQ, and told you my expectations for a bounce, and you could reverse it like I did for a bounce trade. And look, we're right to where that's that golden shorting up. So if you got it, now I'm going to go over a couple things here. Now, first and foremost, we have positive divergence on this 60-minute time frame. So I try to make clear on this. My job isn't to tell you what to buy or sell. It's to give you analysis and to give you trade ideas. And then your job is to decide which trade ideas and which analysis meshes with your own, supplement your own, analysis, trading, whatever. And I often say this: there's going to be times that I'm bullish or bearish on a particular security or the markets, and you may take the other side of that fence. So I do my best to show you objective long entries for both the trades I'm looking for, whether I'm bearish or bullish, as well as the other side of it. And I always say this, I think my skill sets lie is identifying key levels of support and resistance that are likely to have a reaction on there in a reversal. And so where I'm going with that is I'm going to get to some levels and show you again, if you are bullish and have been bullish, and you think, and I'm talking more intermediate to longer term bullish, then you might consider going long here, because this is the first time we've had some clean and now confirmed positive divergence on the 60-minute charts of the futures in quite a while. We had it back here. Nope, that's 2-hour period candles. Either way, I wanted to show you that support zone. I'm going to go down to the hourly chart and I'll show you that divergence is intact. But there it is. There's that bounce target, or the bounce trade, right back to the resistance. So my preference and what I did, so I'm doing the video, I'm back short again. I'm going to try to ride it down for the next leg down. We've broken support. Again, that was good support right here. And we bounced back to the bottom of that support zone. Right there, you have recent reaction lows there and there. Initially, I had the line a little bit above that. So anywhere up to here and not too far above. So if you want to keep it tight stop, reshort here, or let's say you haven't been in the market, you've been waiting to see a little more evidence, but after today you said, hey, you know what, I want to jump on this short train and ride it. Right now is a great shorting up. And it is also, if you went long this morning, I mean, the best op was right there when we were at support. I like to go long at support. I don't go long solely because of divergences, but when I get positive divergence at support, that's the case. Now, I wanted to say that I'm going against what I usually do, and that is usually when I get divergence on the 60-minute charts, that's when I'm positioning for swing longs. I'm closing out swing shorts permanently and going looking to position long for the next leg up, and we may very well get that. However, and I said it back here, we had the divergence then as well. I don't think it's going to play out for a move to new highs. It did not back here, and I don't think it's going to do it again. It could. So again, I know I might sound all over the place. If you are a bull, I cannot see why you did not go long here at support this morning, especially with those divergences in place. They're now confirmed. What you might want to do is, if you're bullish, if we continue to power on through here, clearly through that 15, it's around 15,543, get well back above there, that means that we've regained support, and that's going to be near-term bullish. So the bears should be stepping in here, and I'm speaking metaphorically. I'm talking about sellers as a whole. Should step in here and sell that bounce back into resistance. But if they don't, then maybe we are going to have a rally here that might get some traction. So whether if you're long, I would wait maybe to clear that level by a fair margin. And if you're short, you could also stop out if you want to keep a tight stop. Or you can, swing for the triple or the home run. That's the bigger play, my longer term targets that are much lower, and then give it some room. Look, until and unless we clearly take out the old highs, the case can still be made, especially on the weekly charts, and starting to see some developments on the monthly charts. Well, we won't really know for a few more weeks if those sell signals are confirmed. So that's it. So to keep it very clear, there's that bounce trade. It was good for about almost 2.5% so far. And if you trade NQ, I don't have to tell you how much that means for you. A single contract to NQ, you're talking, $5,000 or so for 2.5% bounce. Yeah, actually more like $6 or $7,000 per contract there. And even the MNQs you can trade. Of course, trade whatever vehicle you want. Don't use futures if you're not comfortable, if you don't know how they work. MMQ is the micro contract. It's just 1/10 the leverage factor is NQ, but it trades off these same exact levels. So that might fit you. And I like those because you're going to see a lot of things. A lot of times I'll see my price targets hit or breakouts occur after hours, where even after the aftermarket session, when QQQ is either no longer trading or the volume starts to dry up towards the tail end of the after hour session or early on in the pre-market session. So you can ride NQs, and if you have a stop loss or price targets hit 3 in the morning, you don't have to be in front of the computer, because if you had a limit order or a stop loss order, it's going to trigger and fill for you. And again, that's one of the reasons there I like the futures contract. So that's it. That's where we're at. Let's not overthink it. Let's see what happens if we can build on these divergences, build on this rally. It's not going to eliminate the bearish case. That doesn't get eliminated until it's all about price action. There's not any one level where I can say, okay, no, we no longer have a long-term bearish case for a 20+% correction if we go over this number. It happens gradually and incrementally. But as of now, okay, you guys know where I'm going. So let's not beat a dead horse. Let's move on to the next one. And that would be, let's go down to the 60-minute chart like I told you I would. And that is right here, NQ. So there's that 60-minute divergence right there. Nice, clean, strong, powerful, positive divergence, just like you had right there, just like you had right there. Even, although it's bigger this time. And these were good tradable rallies, even for an active swing trader. And this is what swing trading is all about: divergent high, be short; divergent low, long, short, long, short. And but now big support, and based on again everything that I've covered, that I'm not going to get into detail in this video, market breadth deterioration, divergences on multiple time frames, multiple sell signals, starting out with the intraday charts and then going into the daily charts recently, and what happened today. That's why I'm going to override my normal bias to go cover shorts and start going long, at least near term, on that divergence low. In other words, I think the divergence will probably get burned through by taking out these previous lows. And if so, then you have the target I already gave you. I'm going to jump back here and then get away from the NQs, cover some other things. That's a longer term target down there, about 14,424. Or you can just align, if you're trading the NQs, align those targets that I already gave you on QQQ. And I went over today, and I'll go over again. Swing target zone down to about 342.40 down to about 355.54. The 200-day moving averages are likely to act as support, and then 360, of course, is the next target. That's just so I think it's something like this. That's what I've drawn out for you. Come down, hit the 200s and that 360 support. Probably get a tradable bounce off there. Maybe, maybe not. Remember, we're getting closer to that point. I think the more we fall from here, the more it is of what I call that POR, point of recognition, where the bulls, the dip buyers that have been doing so well for so long with their simple buy every dip strategy, it starts to be that rut row moment. Hey, things are different now. I've been buying this dip, but now we're down, what is it, from today's highs, or the recent highs to the lows. So far, QQQ has dropped 9.7%. So we're almost, for the first time in a while, in official correction territory, drop of 10% or more. And then, so we'll see what happens. Again, those are the levels that will firm up the longer term bearish case if and when taken out. And that's, again, 360 in the 200-day exponential and simple moving averages, which are just above that. And then at that point, we'll start to continue to, or not start to, but we'll continue to focus on the longer term charts like this weekly chart, and try to see if we can, trade our way down on a much larger drop that could be as much as, instead of just 10% off the highs, I have targets that are all the way down here, about 34. Oh, I already labeled it for you the other day, as much as 34% or more off the highs. And if there's any confusion why this target doesn't match what I showed you on the daily chart of QQQ, or why that chart, first target or swing target on the daily chart of QQQ doesn't match that at NQ, and that's simply because they're different time frames. Active traders are going to gyrate more towards the intraday charts, not just the 60-minute charts. I've been trading off the 5-minute charts today as well. I helped to confirm long entry early on. Let me show you something here. Here's an example on a 5-minute time frame. I'll watch a PPO histogram. You look for these bullish and bearish crossovers. That's just showing you when the PPO lines are crossing, and of course where they are, and that helps to confirm near-term trend changes in positioning. So you can see, we had one there. There was a bearish PPO crossover. Capture that drop, and then we were green, green, green. This is this morning right here, right around when I did that video earlier today and showed you, the case to go long off support. Where we hit on the NQ and QQQ. Remember, my fourth target was hit to the button, and that coincided. We got the bearish PPO crossover, and the rally that followed. And again, you can see T4 was hit. This is a 60-minute chart almost perfectly to the button. That number's at 369.50. The low today was 369.31. So on a 370 point security, you're talking pennies, and that's about as good as it gets right there. And then we also, of course, had, like I said, on NQ, boom, perfect tag almost to the bottom of that target zone. We were right approaching the top of the target zone when I did the video earlier. So there's that bounce. All right, let's move on. Let's look at a few others. ES, S&P 500, E-mini futures, same thing. Positive divergence, 60-minute time frame. We also had a little brief whipsaw, which is kind of bullish because you had a false breakdown. If for those that weren't paying attention to the fact QQQ at the same exact time and NQ were hitting support, that's why again I use the charts of not just one. Even if I'm not trading ES, I'm going to watch it because the ES traders that were looking at this, they didn't see any support. I don't see any on here, although they saw the trend line and they saw that get taken out. So if they shorted that break or added to it or stayed short, well, they got burned so far, at least intraday, because at that moment, that's when QQQ and NQ hit support and they reverse. So that's what case of the tail wagging the dog. The S&P 500 is a more talked about index, especially in the financial media. Everyone's 401ks. You mostly have S&P 500 index funds. You don't have many 401ks with NASDAQ 100 index funds, but the traders like me tend to trade the NASDAQ because you have more juice. It's a higher beta index, more concentration in the tech-heavy big movers. And so that's that. Now, okay, so I showed you the case, all these divergent highs, correction, divergent low rallies. But one thing that I will point out, and that's going into my consideration as to get back short again and not hold that, because that again would normally could prove to be a golden place to reverse cover shorts and go long for the next ride up. But the reason I didn't is when you look here at this QQQ 60-minute chart, you don't have divergence. You do have almost a little bit there on the RSI, but you don't have anything remotely close to PPO divergence. And if we did, that's where I really like to see that. You get the divergence on both indicators. That's usually when you get the strong rallies like that. We do not have anything close to divergence. This PPO is heading lower. So what we could see, maybe it'll set up divergence a little bit down the road. Maybe we go up a little more. Maybe we don't. We drop. But if we go to my T5, maybe it works out something like that and we get divergence there. And then I cover in reverse for maybe a long-term trade. But I don't know. I'll tell you my thoughts if and when we get there. Again, assuming we take another leg down, assuming that T5 is hit, let me tell you what's going to happen. If that T5 is hit, it's going to further strengthen the bearish case, the longer to intermediate term bearish case. In other words, it's going to do things to the daily and weekly charts that you don't see right here. So therefore, I don't know anytime soon if I'm going to be looking to put some trend long positions on QQQ and SPY. Right now I think there's more downside in the coming days to weeks, and I think any bounces at this point in time should be sold into. Okay, so that's the Qs, that's the 60-minute chart. Here's SPY, and here's again a case I'm pointed out. Case for those that are bullish to go long. Just like ES, it was a very slight and brief undercut, but SPY also hit support there, 458. There was a nice gap back here. I've had that line on there for a while, and more importantly, this primary uptrend line from the beginning of October right here. So now we have several reactions. We have a couple reactions back when that line started back in October. Distinct reaction there, and now a distinct reaction here. That helps to validate that trend line. Again, we do not have any positive divergence on the PPO. Little bit of divergence there on the RSI, but no PPO divergence. Trend indicator is interesting. You can see I've had this line here for a while. It's negative 0.56. That helps to delineate bullish and bearish trends. In other words, you look at the signal line, the white line, the 9 EMA, when it's above there, as it has been. Let's roll back here. All this while, bigger picture, this has been an uptrend, right? The S&P 500 has been moving higher. It's been grinding around, has corrections, but it's been moving higher. And you can see how well this line works. That white line, it acts as support when it pulls back. When the white line's above, there was a brief dip, but hardly there. Again, support, support, perfect tags right here. Perfect, 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 perfect tags. Again, of the white line, because that's the last two to cross. We're just a hair below it now. So this is a key technical juncture, at least from this one indicator, where again, the bulls, onus is on the bulls to step in here. Defend this trend line right here that we're at. Defend the PPO, keep that trend indicator bullish. If they don't, we have another leg down. Well, number one, you're going to break the trend line, and there's a sell signal for the bears, and you're going to take out, really you want to see today's lows get taken out. You're also going to see this trend indicator for the first time in many, many months flip if that 9 EMA dips below that 0.56 level, because again, that's defying the bull trend there in the S&P 500. QQQ, you can probably see something similar. You know what? That line should be moved down. I'll just put another one up here for you. You look at each index, it's a little bit different. So there's a line right there that usually contains, probably push it up a little bit more. Yeah, that would be, because I have to come in with the white line. That white line should be a little thicker here. Let's thicken it up. Make it solid at least. No, there we go. Good enough. I think you can see it. And last but not least, let's not write off the SPY yet, but let's keep a close on it. Remember, this was a previous all-time high. We broke out right there, and we back tested once, twice, and we're close, but not there yet. So I have a yellow line I gave you guys recently on SPY, and that's about 450. I don't know, 450.01. Let's get rid of that 0.1. So 450 is a big level that needs to get taken out. When that goes, I would say the odds shoot up from where they are now, maybe 70, 75%, probably to 85, 90% that we're going to go on and at least hit my next targets of the 200-day moving averages and those levels below that I showed you on the QQQ daily chart as well, and here on SPY, and then quite possibly more, again, based on the big divergences there. Next up, ZB. We're getting that flight to safety bid, or at least early on today. Remember, I said if the markets, start to continue down, we'd probably see institutions sell stocks and buy Treasury bonds for safety, and that's what we did. So we still have that setup I gave you yesterday. You have resistance at 155, 173, which is a safe bet. We did break above the wedge, the steep downtrend line. So that is a breakout. You could be long treasuries now. You could have been long yesterday as well. But if we take out that 153, 173 level, I think that'll help seal the deal or do the trick for this bullish falling wedge breakout and take us up to those targets I gave you for ZB. And for those of you that prefer ETFs over futures, you have TLT. Pretty good support down here at about 141. Actually, there's a line I should have a little bit above that. And here's that previous reaction low. And that's right where we are now. You can see that reaction low there. We're right there right now. PPOs looks like it wants to turn up. It hasn't done so yet, but either way, I'm looking for just some money starting to come into treasuries. Probably bounce up to at least that 146 level at minimum, I think. And it all depends on what the stock market does. Because if bulls can continue to rally this up, buy this divergent low, build on those 60-minute divergences that the futures have, then you may see continued weakness. I've been clear on this for a couple of years now that the long-term outlook for Treasury bonds is nothing short of abysmal. There's really no upside for Treasury bonds long-term. Best case scenario, we have persistent weakness in the economy. Fed backpedals and goes back to dovish, keeps rates near zero at the floor. That just keeps, and they somehow manage to contain longer-term inflationary pressures, or not. But treasuries will probably have nowhere to go but up. And if inflation gets out of hand, believe me, the Fed can control the short end of the yield curve directly. But the farther out you go, they can do all they can. They have some power. They have a lot of shenanigans they can pull, bond purchases, things like that. But ultimately, the markets are going to set the rates for long-term Treasury bonds, and so if rates go down, that's the only upside you have for TLT. But if rates happen to go up, longer-term rates, then TLT is going to continue to fall. Anyway, I just, Treasury bonds I have thought for a while and will continue to just view as trading vehicles, nothing buy and hold. I don't see any buy and hold opportunities there. And crude oil, I gave you the long-term charts recently, and I've covered them quite a bit, but most in the last update, most recently, I pointed out this bearish rising wedge on the 60-minute chart we're looking at here, and said we needed to break that to trigger the next sell signal in crude oil, which happened. There's the breakdown, but I believe I also said, and if I didn't, I'll say it now, that it will really help to take out this 77.65, because when I have a support level I'm looking at to, let's say in this case, short or add to a short, such as the rising wedge and the uptrend line, but then there's another even as good or better support level just below, which there is in this case, that price level. You give it I call it the benefit of the doubt, or BOD level right there, 77.65. So we broke down and we hit it, and we're bouncing around. So break of that should open the door for a relatively swift move down to the next target, 74.95, and at minimum, if that wedge breaks, at minimum I think we'll come down here to 72.87. Quite possibly more, because I've made the case for a major top in crude back here a couple months ago, back in October I think it was. Well, a triple top here on this 60-minute chart all the way into early November. Nat gas getting close. I've been highlighting these divergences for a while. They continue to build all the way here. This is a 60-minute chart or hourly chart. And then I gave you, gosh, a week or two ago, a couple weeks ago, this horizontal line at 3.928, that is. Yep, 3.928, because we had a big old gap right here and then two distinct reaction highs. That's kind of put us in this trading range right here. So crude's been basing in this pattern. I've added this level here, a little uptrend, near-term uptrend line that could trigger weakness if taken out, more downside. But we hit that level several times today and failed to break it. If and when we do, which the divergences indicate that's the most likely scenario, I think we can swing nat gas up to here, 4.452 or so. So we'll call it 445. Target for natural gas, at least. That's just a swing target. And we'll see how things look when we get there, if this downtrend line comes into play or anything like that. So it's still kind of grinding around, waiting to pop that level, and that'll give us an entry. And then if it does, and we get the entry, then we might want to watch this trend line for a pullback to that trend line to add to a position. And a break below it could also serve as a stop loss level, a solid break below it. And that's about it. I'll bring up sugar. I've covered this one recently. We've had quite a few trades, long and short, and I pointed out to you guys in the last few weeks. It's just this beautiful pattern I've picked up on with the combination of the RSI pullbacks to this level, which is about 20 on the RSI. Both pullbacks to that level. And if you get divergence, great. Sometimes you get it, sometimes you don't. And then also these low-level bullish PPO crossovers like we have right here, the white lines. The red lines were my sell signals. And I don't have each and every one marked. Yeah, but I do. I have one here. So bearish PPO crossovers that occur down well below the zero line right there. And there it is. And this one hasn't happened yet, but it's getting close. So again, that coupled with this, PPO and RSI buy signal. There is a buy signal, buy signal, buy signal, buy signal, buy signal. You do the math and see if you'd rather be long or short when that happens. So it's been so far, batting 1,000 with these signals. And again, I've given you the same thing with these overbought readings coupled with the bearish PPO crossovers as sell signals. So that's it. So a little more work to be done to get a bearish PPO crossover. We're not there yet. Let me refresh that, make sure. Yeah, that's it. But looks like we'll probably get it soon, especially the fact that we've even come down to that level. Usually that's all it takes. Pullbacks to that level have been followed by rallies that usually give you, just again, swing trading, in and out. I'm not being are getting married to any commodities at this point in time. I remain longer term bullish, but they've been in as gold and silver in correction mode for a while. And so when you recognize that, then you go get into hit and run mode, and that means active swing trading, in out, long short, and then when the time is right, we'll get back into these. I'll start highlighting some objective re-entries for longer term traders and investors. All right, we're right at the 30-minute mark, so let me wrap it up here, get it out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.